Hello everyone and welcome back to a Week in Markets review. Now, given markets are performing so well, we thought we'd take a step back at this point in the quarter and reflect on performance delivery through quarter two. And that's because we now have the ARC data, which many of you will be familiar with, published and ready to show you and demonstrate how well the portfolios are doing relative to an industry peer group. I am delighted to be joined today by both George Bell, Investment Manager and in charge of the TPP portfolios, and also, for the first time, Lexi Herriott, Investment Analyst and Growth Aligned Specialist. And we've brought Lexi here particularly to talk about Growth Aligned, given the very strong quarter and year that the Growth Aligned funds are having within the portfolios. So we're going to begin today, first of all, with a fairly standard table for you, which is calendar year data from Q2 this year going back over the last 5 years. And what you'll see on that is that each of the four main risk profiles here are illustrated, going from cautious all the way up to aggressive portfolios. And at the bottom of each section, you'll see we show performance for the ARC Sterling Index, that peer group which you should reference against your risk profile. And what we're delighted to show you is that particularly in the last 2 years, performance continues to be very strong and in relative terms is exceptionally strong against that ARC peer group. But bringing George in particular, what we're now going to delve into is particular Q2, what drove the outperformance there. So George, let's bring you in. If we just focus in on the Q2 number on the next slide, which has got a lot of numbers on it, it's been a strong quarter.
Absolutely. Strong in absolute terms, but particularly relative to the ARC reference index here, which we've got on screen. If we just think back to the quarter which we had, it was quite a remarkable recovery in markets. It was a period in which Trump opted to introduce a 90-day pause on the implementation of tariffs. So that led equity markets to breathe a sigh of relief that things weren't going to be as bad as expected for their profits, but also for the bond market on the view that inflation expectations weren't going to be as high. In terms of what it meant for the portfolios, we were rewarded for the disciplined approach which we had around our investment process, which enabled us to maintain our overweight allocation to equities. But also within equities, the approach which we'd taken over the last number of months to rotate away from the US to become a more internationally diversified equity exposure, which was a benefit to the returns which we've delivered.
Great. So the portfolios really did benefit from that broader equity exposure because it wasn't just an equity rally led by the US, such as in 2024. We've had a more balanced uplift in equity valuations, particularly since the tariffs were rolled back. So very strong numbers there, George. Very strong since inception numbers of the long term. But one of the IPs of the ARC peer groups, of course, are the quartiles. So let's speak about the quartiles. And I guess it's at this point, if you could just give some colour and background on who ARC are and why we believe it's important for our clients who are invested in the portfolios.
Yeah, absolutely. So ARC really helps us articulate the performance of the portfolios relative to the wider industry. And there's a couple of reasons for why it's an important reference. It's independent in the sense that it's an independent comparison of portfolio returns which have a similar level of risk to those which we provide. It's a very high quality data set. So you've got over 200 different firms and investment banks which are feeding into this. You've got a few examples on the right hand side of the slide there, and that's over 500,000 different investment portfolios which are within that data set as well. And it's a level playing field in the sense that...
And that's the key part, isn't it? It's the risk profiling that ARC do for us, ensuring, as you say, it's apples versus apples comparison in producing these data sets.
And also net of the portfolio and the platform charges as well.
And of course, net of fees is very important for our clients.
Absolutely, and absolutely delighted to demonstrate that we sit in the top quartile of that industry comparator, not just in quarter two, but actually across all periods, which we can see on screen, particularly the long term, which is a really important aspect. We are long-term investors here at True Potential. And within that data set, you are going to have some more challenging environments. You may see periods where we do drop down in quartile rankings, but it is a very competitive peer group. And what's important is we maintain within that first quartile over the long term.
Absolutely. And of course, George, you did say that there's over 200 portfolios in there for comparison, and we can see on the right pane on the screen of all the competitors who are in that peer group. So it's a very blue chip dominated peer group. You've seen names from Aberdeen, Barclays, St James's Place. So it's the right type of peer group to reference. Now there's a lot of green on this, so let's bring in Lexi. Lexi, you're on the Growth Aligned team. It's a fund that's close to my heart. Can you give us some context on Growth Aligned and what they did through Q2 that helped contribute to this performance?
Yeah, so Growth Aligned is our in-house fund manager at True Potential and was one of the top performing managers over Q2. So we went into the quarter marginally overweight equities and then started to increase that equity overweight following Liberation Day and tariff announcements. So this was really our key driver of performance. When we were adding equities, we were adding it to UK, Europe and emerging markets while still holding a large allocation to US equities. So those all provided positive performance to our funds.
So that helped for a very strong Q2. But of course, as Georgia said before, we're long-term investors. We're here to deliver and compound long-term returns. Maybe it's just some context on the longer-term delivery from Growth Aligned over the year.
Yeah, so over the year, again, our overweight to equities was helpful, as well as an overweight to high yield within fixed income. Within equities, we had a more global equity book, and Growth Aligned is also made up of both passive and active funds, and our active managers outperformed their benchmarks, which boosted our performance.
Excellent. And it's obviously Growth Aligned is just one of the core funds in there, but we know, for example, that Schroders have contributed very strongly to that performance over the long run as well.
Yeah, so over the 1 year, Schroders were the best performing manager in True Potential, really helped by gold miners, which actually returned 55% over the year to the end of June, as well as physical gold. They also had strong selection in UK and Europe equities, so this helped them despite having a lower equity allocation relative to some other managers. That selection and the gold miners made them the best performer.
Brilliant. So Growth Aligned and Schroders are the top quartile funds within the portfolios over the last year, helping to drive this performance. Now, George, it can be quite difficult to talk to this slide because it's just pure green and every number's one, and that's a great place for our clients to be in. But it's important, I think, to contextualise the decisions that we've been making over the long run, which Lexi's alluded to there, that's just helped driven this performance. Yeah. Anything you'd like to bring out?
Absolutely. If we think about the type of environment which we've been in, we've seen quite a material shift where it's been US leadership and then equities outside of the US which perform much better, and we really benefited from that. As we look ahead into the next quarters, essentially what we're looking at is an environment where we believe equities have got the ability to deliver positive returns. At a global level, you've seen the de-escalation of tariff risks and more severe inflation risks. And at a regional level, you've got support there for consumers from corporate health, lower interest rates and government spending. So that's a fairly robust backdrop in terms of what we can see for equities as we look ahead. Within the bond market, we are neutral in terms of the allocation. We've got government bonds which are still providing a fairly attractive yield and offer support within portfolios should we see a more negative economic growth environment emerge. High yield's been an area which has been of greater interest to us within the portfolios for the all-in yield which is available from that asset class, and we have been willing to take a little bit more risk within markets. And we still have alternatives in there should we get more challenging periods for equities and fixed income. And we've got cash within there, but both of these asset classes have been at an underweight position, which means that relative to an equally weighted model of funds, we've got less in those asset classes. We've been more risk on in our approach. And that's really led by the investment process which we have and the asset allocation committee which we have here at True Potential. And it's been a rewarded outcome for investors in absolute terms, but also it's helped us perform very competitively relative.
Absolutely, George, and congratulations to you as well, because it doesn't really come out on the call, but just how patient and calm you and the team were during the Liberation Day tariff sell-off, and you and the team held firm on the portfolios and allowed markets to recover, and that's benefited through Q2 in particular, and as clients can see that the long-term numbers are fantastic. So, I mean, that's all for today. It's just a short burst on performance with you. We like to do these every quarter just to update you on the ARC data. We know how important it is that you get some form of reference for how the portfolios are performing in the industry relative to these robust peer groups. We're delighted the message is so strong. If you do have any questions, please do get in touch or reach out to your advisor, and I'm sure they'll be delighted to give you some context. Please do like and subscribe on the YouTube channel, and please do join us next week for the week ahead. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.